Hello and a very warm welcome to Daily Finance Wrap. I'm Mubina Kapasi and this is the show where we get you everything you need to know with respect to personal finance, right from how to handling your investments, insurance, effectively managing your taxes, and of course, those loan bills that keep coming in. We also get you the top stories of the day, what's transpired in the markets and in other corporate stories, and news that may or may not affect your personal finances. Let's kickstart the show. Then we have a very interesting topic lined up as well for you today with a personal finance expert. And of course, don't forget, if you have any questions or queries with respect to how to invest, how to build a portfolio that helps you create wealth, then do write into us. You can, of course, comment on this YouTube video and just write in and we will take your question live right here on Daily Finance Wrap. Let's kickstart the show then, and we have some of the top stories coming in right here. The market downtick continues. It is a fourth straight trading session then that the Nifty and the Sensex have actually edged lower, selling in FMCG stocks, particularly Hindustan Unilever, which we will talk about in just a bit. Auto shares as well that have sort of triggered that sell-off in the market today too. Though, mind you, sell-off would be a bit of an extreme word because the Sensex has been flat and the Nifty has ticked lower by about 0.15% or 36 points. But nevertheless, it is a day in the red for the markets, and that's something that's disappointing a lot of the bulls, on the Lal Street. And then, of course, there's that unabated outflows by FIIs. This month in particular, the outflows have been quite relentless. And, one would think that considering the US Fed has cut interest rates, those outflows would perhaps be a bit more restricted. But nope, it continues this month as well. In terms of the other big laggards, I already spoke about HUL, but then there were also the other FMCG players like Nestle, ITC, consumption player Asian Paints as well that found itself, on the lower side of the market. Maruti, TCS, L&T. So these are all really heavyweights that were laggards. But in terms of gainers, M&M really managed to buck the trend in the green. So it bucked the trend not only for the benchmarks, but also bucked the trend seen in its peer space, and that is auto. Ultratech Cement, Adani Ports, SBI were some of the other, small gainers today in trade. We have the October PMI data as well that was released, and it indicated that the country's healthy growth continued, which supported RBI's growth guidelines as well for FY25. So I guess that was some smidge of positive news coming in. But HUL, yes, this is the big story today, as Hindustan Unilever shares had dropped by as much as 7% on an intraday basis after the company reported a weak set of numbers for the second quarter. Of course, the company pegged it on to weak economic conditions. Revenues, the growth over there was at the revenue number was at 15,500 crore rupees, and the volume growth came in at just about 3%, which was slightly below expectations. Brokerage houses did give the numbers a thumbs down, but nevertheless, many of them did maintain their stance. So, for example, JP Morgan maintained its overweight rating on the stock, but reduced its target price. So instead of 2,950, they cut it down to 2,870. JP Morgan also cut their earnings per share estimates for the financial years 25 and 26 by 3%. Similarly, Jefferies too maintained their buy rating with a target of 3,310 rupees, 3,130 rupees, pardon me. So one of the more higher ends of the range that a lot of these brokerage houses have for price targets for HUL. And among other important news coming in, this one is especially for all of you who are employed with the central government. If you opt for voluntary retirement, there's some smidge of good news. There is a revision in rules for employees and pensioners that have come in from the Department of Pension and Pensioners Welfare. They focused on clarifying service-related issues for those under the national pension system. Now, under these new rules, the central government employees can now choose to take voluntary retirement after 20 years of regular service. And to start this process, they need to, of course, provide written notice of at least 3 months to whoever their appointing authority is. And if the appointing authority does not respond within a certain period, then the retirement will automatically take effect at the end of the 3 months. So certain rules that have been simplified, and remember, this new provision though does not apply to employees that will retire under the special voluntary retirement scheme. It's only for regular voluntary retirement. So that's, of course, some important news coming in for all those individuals who are employed with the central government. But of course, I think we're going to continue our conversation around this entire market volatility that we are seeing in the Nifty and the Sensex. 4 straight days of relentless selling by investors today, and there are several reasons behind that. So we'll discuss firstly, what are the reasons? Secondly, what does it mean for investors? Where should you invest? What are those buckets of safe havens perhaps to hide from this volatility, if there are any, of course? And finally, of course, should you be worried about all these short term bouts of volatility? Because this is not the first time that we have seen this selling pressure. And unfortunately, it's not going to be the last either. So let's discuss all of this and more. We have with us Dilshad Billimoria, the MD and Chief Financial Planner with Dilzer Consultants Private Limited. Hi, Dilshad. Thank you so much for joining us today on the show. And yeah, I mean, I'm sure your clients have been calling you perhaps these last couple of days, asking you that why is the market falling and what should we do? So let's talk about this market dip that we are seeing. I know earlier in the show we discussed some of those reasons, but an expert opinion is always welcome. Dilshad, according to you, what are the factors behind this fall in the market that we're seeing for the last couple of days?
Hi, Mobina, and thank you so much for having me and connecting again. Yeah, so I think there are several reasons that have actually caused this fall. It all started with the China announcement, right? So Chinese government had, given economic measures to kind of boost the economy because it was falling. And then we, had a lot of FII investors moving. In fact, 40 billion is the normal FII allocation to Asian markets on a weekly basis. When the news came from China, actually 39 billion moved straight to China, and that's where the money was kind of, a profit booking was done from the Indian markets and moved. But not only China, so there is Indonesia, there is South Korea, there is Taiwan. And this is where actually the money is flowing from India and outside India, and that's why you're seeing most of the market fall, which is happening. It's been almost 5.5% fall September to date in terms of the Indian markets having fallen. But having said that, there is absolutely nothing to worry. I think it's just the valuations that has, peaked out in India, and that is what is causing FIs to profit book the money and move it out of India into these other emerging markets where valuations look more attractive. So typically, Indonesia, or if in fact Taiwan, because their currency was devalued, and South Korea, all these valuations range between 17 to 23 PE. And compared to India, we're seeing that these are attractive markets, and obviously money flocks where returns are high. And that's why we are seeing money move out of Indian markets. But this is a temporary phenomenon, and we don't expect, the kind of, volatility to sustain for a very long time.
Well, of course, for us retail investors, putting our money or moving it away into markets like Indonesia, Taiwan, etc., is a bit of a stretch. So that's the reason why I'll ask you that. Then, Dilshad, for regular investors, if they want to sort of find some, refuge from this volatility, if there is a space like that, what would you recommend, especially newbie investors, right, who are considering looking into the market but probably are in double two minds because of this move?
Right. So I think every market fall is an opportunity, right, at the end of the day. So, when there is a market fall, as long as the underlying or the fundamentals or the corporate results and earnings are strong, which they are, we have seen, the last quarter earnings also doing well in most of the blue chip companies. I think that's where investors should look at starting. In fact, large cap and blue chip stocks are the ones where investors should look at allocation, because typically that's where the FII money flows to, and these are stable, where market capitalization is above 40,000 crores, 50,000 crores. So that's where the first flow in of money happens. So ideally, for the newbies especially, I think allocating to blue chip stocks is something you typically won't go wrong in if your time horizon is long enough.
Yeah, I think that's the reason why they are called blue chip as well, right? I mean, these are companies that essentially have a great pedigree. They have a proven track record, a well established track record of being able to survive volatile times. So I guess it's natural, that these are the ones that may not be that affected with the ups and downs because hey, they've seen quite a few of them in these last in the years that they have been present in the on the Lal Street. Let's talk about it from a mutual fund point of view, of course, Dilshad, because that's the one way that many of our viewers will consider investing money in equities, especially those who do not know how to go about individually cherry picking stocks from the large street, considering there are thousands of them. So let's talk about mutual funds. And also, Dilshad, as we know, the concept of mutual funds, that there are many stocks that are bucketed together and put under one fund. So am I right in saying that perhaps volatility won't affect mutual funds too much?
Yeah, I think the best way for an investor to start is through mutual funds. Personally, we have recommended that unless your portfolio exceeds 50 lakhs to 75 lakhs, we do not suggest individual allocation to stocks. The reason, like you rightly said, Mobina, is because of the diversification that is there. So, if, for example, like you mentioned today, HUL fell, because of earnings, not meeting the estimates. So if somebody was holding the HUL stock, they would have automatically had a big loss, on their investment. But when it's a portfolio of stocks, automatically the standard deviation or the volatility reduces because of the diversification, and that's what causes actually the return to fall lower when compared to direct equity investing.
Okay, understood. Now, could you talk to us, because mutual funds, there are several categories. While there's equity and debt, within equity also there are very many categories. How do these different categories of mutual funds, in your experience, move in volatile times? Like you already gave us a bit of a hint, right? That large caps and blue chips, pardon me, will be relatively more stable. So if you could break it down for our viewers, that how do you see these different categories of mutual funds react to market volatility?
Right. So, ideally, the large cap, stocks are the fundamentally strong companies, and that's where typically the fall expected is much lower, uh, followed by flexi cap. And at some point, I think about 2 months back, we saw valuations on small caps, hitting very high, kind of valuation prices, and that's where we suggested a profit booking for clients. So I think even within equity, you have large cap, you have flexi, you have mid, you have small, you have multi cap, and you have thematic, you have multi factor. So there are so many categories of investing. And it's good to actually consult with a financial advisor to know exactly what is one's risk profile, what is the risk appetite, what should be the ideal asset allocation to actually build a portfolio across these various categories, because there are over 4,000 mutual funds, schemes, spread across about 40 companies. So that's again a very big kind of sifting and filtering that needs work to be done. So it's best to work with a financial advisor on this.
Yeah, absolutely. I mean, I was going to give a number to the mutual fund categories, but I didn't want to, risk it because I'm pretty sure my number would be wrong. And yeah, I mean, with the number of mutual fund houses that are growing and all of them coming out with NFOs, especially in these last few months, of course, the choice is really very, very large. And sometimes that leads to more confusion. So now is the time, all the more, that I think investors must always consult their financial advisor, because you have to make the right choice from all the available choices out there, which are only increasing in number. Now, Dilshad, like I asked you at the beginning of the conversation, that I'm sure many of your clients are calling you and saying, why is the market falling? What should we do? Should we move something around? Should we get out of equities? Should we move our money in savings accounts? So, what's your advice to all these people who are panicking right now?
So I think as long as one's kind of goals are adhered to, and the kind of asset allocation that is between equity and debt is safe as per the risk profile, plus or minus about 5-10%. I think that's a very good place to be today. And typically, investors. I mean, our clients look at kind of investment options which are more than 5 years old. So we would do course corrections, and by course corrections, I might say rebalancing, or I might say a portfolio restructure, or I might even do a profit booking, depending again on a specific investment objective, need, and goal of that client, and very importantly, considering the time horizon of investment. So I think a combination of these factors is what is keeping our clients happy. Because there's a constant kind of financial awareness that is given to them in terms of what they are heading towards, where they are going, and how best that we are doing in terms of our research to meet their goals and objectives.
Understood. Yeah, you actually, since you brought up the topic of rebalancing, that's something as well that I was going to talk to you about. That when markets move the way they do, whether on the downside or even for that matter on the upside, is that a good time to sort of give your portfolio itself a review? Because it's a healthy financial practice to keep reviewing your investments, see how they are doing, are they still matching your goals, so on and so forth. So do these kind of occasions when the market is down, or for that matter even let's say when the market will rebound and rally and perhaps hit new records, are these two ends of the spectrum good times to consider rebalancing?
So there are two parts to this. One is a kind of a portfolio review. And the portfolio review could also mean doing nothing to your portfolio, right? That is also sound financial advice. But if there is a market movement which is very steep, either upward or downward, again we look at how much deviation is it from their targeted or desired asset allocation, and then only make course corrections. Remember, every change that you make to an investment portfolio, especially in listed equities, mutual funds, have a cost, right? So one is the exit loads, one is the tax implications. There might be a few of them which have lock-in periods. So you need to be very careful when making recommendations on rebalancing or profit booking. And when something doesn't do well, I think you need to give it some time before jumping and acting upon it immediately. So evaluating and kind of putting internal triggers and then taking an informed decision to make changes is what we would recommend.
All right, understood. Just for the benefit of any viewer who's tuning in right now, I know you mentioned large caps and blue chips are a good place to begin with for investors, but any other fund category, that you would recommend investors, which will help investors tide over volatility?
Yeah, definitely. I think gold is a good hedge, and multi-asset category is a good allocation to have. Typically, gold kind of has a negative correlation and does well, when in war-like situations. So I think it's best that some allocation is done to gold. And again, there is a very interesting kind of strategy called the multi-factor investing strategy, right, which combines value, low volatility, quality, and momentum. And ideally, an informed investor should have all four built into their portfolio. So they're able to ensure that at any point in time, if, say, quality does well, their portfolio would do well. Or if any one of the factors don't do well, there's always, like in a downturn market, a low volatility would do really well because you're protecting the downside risk. So that is where we try and build the alpha into the portfolio.
Okay, that's an interesting fund category that I'm sure many of our viewers also may not be aware, because we know of your large cap, mid cap, small cap, flexi cap, but then there are also these kind of mutual fund products out there like multi-factor funds, which could help you tide over volatility. Of course, Dilshad has given a brilliant explanation for this, and I would recommend every viewer out there read more about it, talk to the financial advisor as well about this, especially if they're worried about volatility. And like Dilshad said, sometimes doing nothing is also a great thing to do during volatile times, as opposed to getting in there and figuring around. Dilshad, one question then: do you think we are in store for tougher times for the equity markets?
Well, that's a tough one always, right? So I think it's safe to say that yes, the markets might fall between 3 to 10% more. And we also have a very important event, the U.S. elections coming up, towards November, and of course the results finally in the swearing in happening in Jan. So I think and again, of course, towards the end of the year, a lot of FIAs actually book profits, right? So there are multiple things happening. While people book profits and move out, they would like to show profits in their books. That will definitely cause a kind of downturn, But like I said initially, these are very, very short term volatilities. What one needs to look at is the fundamentals going strong? Are the is the economic activity picking up? What are the macro factors in terms of the GDP, the inflation, the interest rates, monsoons, etc.? Are they on track? Are they helping companies to actually increase the PAT, and of course ROCE, the return on capital employed? I think these are the factors that are the underlying decision factors. What's happening around that is just noise. So please stay calm. I think that's very important, and not overreact, when it comes to sudden upturns or downturns.
That was exactly going to be my next question, because money is obviously a very emotional subject. Today, people have worked hard, to earn it, and then when they invested in the hopes that the money will grow and compound for them, which they hope equities will do, to see such a drop, it's quite disheartening. And then people tend to have a very negative approach to investing, to equity markets as well. So, what is the attitude you would advise people take when they consider putting their money in equity markets? Because the fact is, this is not the first time that we are seeing this undercurrent of selling in the market, and nor will it be the last.
Yeah, so I think by nature, one must be very aware and clear that when I invest in equity, there is definitely a downside risk. Now, how best can I reduce that downside risk? One is by increasing my time horizon. Two is by choosing an asset category within equity that is less volatile. And three is by building a basket or an asset allocation that is overall going to ensure that if one particular asset category doesn't do well, I'm, kind of providing a cushion by investing in other asset classes that will protect that downside, because of that negative correlation between different asset classes. So I think these are the factors. And like I said earlier, every market fall is actually an opportunity. So when we make recommendations, we actually hold some amount in liquid or cash because we want to try and take advantage of these tactical movements in the market to add more when the markets are falling. And so that is an opportunity. As long as the fundamentals are strong, you just need to stay calm and ensure that you are following the course of your plan of investment.
All right. So have a plan in place. Don't just go about randomly picking stocks in the market. Create a plan. Why are you investing? How long are you investing for? How much money are you setting aside? And then stick to the plan. Don't really waver too much from that plan. You don't need to really respond to every action that the market takes, because that's the nature of the market. One day up, one day down. It does not merit any action from you every single day, unless of course there's something that happens in your portfolio that considerably moves you off track from your eventual financial goal. Okay, well, this is the time when we also take on board some questions and queries from our viewers. Remember, folks, you can comment on that chat box over there, and we will get Dilshad to answer. So we have our first query coming in from Rag25. He asks that September quarter numbers results haven't been very encouraging. Is that a matter of concern for investors? And Dilshad, do you think growth is tapering?
I think it's too early to, kind of lay that as an assumption. See, the main thing is that inflation and, rising prices has typically, caused especially even consumer stocks to fall. I think if the, kind of cost estimates are kept within the budgetary limits of the organization, I think it's possible that things would look up. But yes, having said that, one needs to be very careful about the kind of high and immediate rise in some of the stocks, and so profit booking is something that one must always look at when their internal triggers are met.
Understood. We have another question coming in from Chirag Gala. He says, as a new investor, is it better if I invest via MFs in equities? How effective is that for providing me a cushion?
Absolutely, right. So I said that before you enter into the world of stock investing, I think it's very important that you build a cushion in mutual funds. And mind you, today you have every category of mutual funds available, right from IPO investing to hybrid to a low volatility to a gold and the multi-factor and so everything is typically covered, right? So why wouldn't you actually take the benefit of professional expertise or a professional fund manager when they are doing a great job for you and delivering double digit returns today at the cost of lower volatility? So I think that's the right way of starting to invest, and the power of compounding is only going to be on your side if you stay the long term.
Okay, Chirag has one more question. I think we just have a little time to take that on. What's the ideal portfolio composition to hedge against volatility or to minimize risk, Dilshad?
Like I said, a combination of gold and low volatility kind of stocks or low volatility funds is what one should look at when they're looking at building kind of a hedge in their portfolio.
All right. I hope that's answered all of our questions. And I think this was a very insightful conversation. I guess a much needed one as well to assuage some of those nerves out there. So, Dilshad, thank you so much for joining us today.
Thank you very much. Thank you.
That brings us to the end of yet another episode of Daily Finance Wrap. I hope it was an insightful one. Thank you so much for watching. Do stay tuned to Personal Finance TV.